All right, so the markets ended the week on not such a bad. I mean, we had a bad Wednesday, but Thursday and Friday we had some volatility coming out of the FOMC, but wasn't so bad. Ended up not being a very. We didn't follow through on Wednesday's selling post FOMC, and so that's actually not a bad thing. The markets, the odds of rate hikes are not going up anymore. The odds of rate cuts are going up, and the markets have liked that, at least to a small degree, very limited to a very small, well, not very small, but a small area, but a large area when it comes to market cap of the markets and those QQQ names. We've seen this kind of pattern before, so I'm going to break down kind of when like how bullish it is for the Qs to be doing so well relative to IWM, when we've seen this pattern before, and how it resolved itself then, and how we may expect to resolve itself again this time. So we're going to talk about that. We're going to talk about some other signs that kind of support our expectations in either direction. So we're going to take a look at that. And we're going to take a look at what's driving this price action here recently. Some interesting moves here at the end of the week, especially from a sector standpoint today. It wasn't really the same move that we've seen the rest of the time from a risk aversion standpoint. So we'll talk about what that means. And then our trade ideas in an area that has in that QQQ space, XLK space. And so we'll talk about how to trade that to see if there's anything we can do to take advantage. So let's go ahead and get started. Today is Friday, March the 24th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down here, you can see some things that Brandon posted here over the weekend. New dividend aristocrat list, and as well as all the sector lists that we put out there for our Market Scholar subscribers and charts that we put out there. Come down here to the bottom. Again, over 100 likes. Again, thank you all very, very much for doing that. Click on that heart, opens up this tab, hit that like button. Click here, opens up this tab, hit that like button there. Again, the more you do that, it really helps us out a lot. That's why we always ask for it. We would love to see it getting above 100. That's great. It's like multiple times in a row now that we've been above 100 on these videos. So thank you very much. And again, those who do that, keep on doing it. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. We finished Friday on a really good high note here. Well, relatively good high note. At least it wasn't down at the lows, where it could have been a lot worse. As a result of the last couple of days of not following through on Wednesday's selling, we avoided a decline of the intermediate line. The intermediate line is actually rising again. Not a lot, and it's not very high, but at least it's above 4. It's out of bearish territory. It's not above market sentiment yet. Short-term sentiment has bounced. The momentum line on Wednesday fell to extreme lows. The near-term line did not follow suit. It barely, I don't even know, it didn't even get in the reversal zone here. Just barely avoided it. And now they're bouncing, right? And so that's the benefit. Now, we didn't, break up above yesterday's high. We didn't get above Wednesday's high. So it's not like we're breaking out. But, it's, at least we're not as, it could have been worse following Wednesday if we would have followed, we filled in that gap, and things could have been a lot worse there. Coming off of that peak on the near-term line, that was a fluff peak, right? Because we went up, we went further than the momentum line suggested we should. Now the momentum line's rising. The question is, how far up will it go? And that's a question that will be resolved on Monday and Tuesday. And that will kind of give us an idea of where the near-term line will end up going and how far it will stay, at least in bullish territory. The further and longer, the better, right? Then that means the intermediate line's got a chance of getting above market sentiment again, and then working its way into the bullish territory and starting a bullish trend off of what would be a slightly higher low point. So a good move there on the S&P 500. Here's the Dow Jones. Remember, the Dow has not been nearly as bullish, but at least it rallied too, and you can see it rallied. Short-term sentiment rallied as well. Market sentiments in bearish territory along with the intermediate line. So not as bullish as we could be, But again, at least three of the four lines are pointed higher. So again, and if you're looking for positives, if you're looking for a way that we might actually get a bullish move out of this, we got these Fibonacci lines that you're trying to, that you were flirting with breaking down below the 62% retracement of this intermediate decline that we more than retraced back up here with this fake out pattern, and then have been working our way back down. Remember, this is the only one that did break, that did more than retrace that intermediate move down to those mid-October lows. And you also have this 38% Fibonacci level of the correction low that we had broken up above, actually got above the 62% retracement, well above the 50. And now you're still below the 50 and seeing if we're going to hold that 38% on the way back down. Here's your NASDAQ, which has been really bullish. Again, there's its 38% retracement of the correction. So it's used it before on that exhaustion gap for resistance, and so far is using it right now for resistance, as well as a boatload of other, including the 78% retracement of this intermediate run. Remember, the Dow more than retraced it, and the NASDAQ just didn't come close. But now it is. Now it's catching up in terms of relative strength. The intermediate line is back above market sentiment. It's rising. Market sentiment's rising. Short-term sentiment's rising off of what would be a bullish low point here on the near-term line. So there's some really good opportunities to be bullish going into next week if we can really follow through, right, and not, not just kind of fake out again, right? If we can break through, get through these resistance levels, 13,000 plus or minus, 100 points or so, get through all these lines, and then, away we go to the upside at that point. On the other hand, the Russell 2000, again, there's the 38% retracement that we're nowhere near on the Russell, right? And again, that 78% retracement on the on this intermediate decline, again, that we're nowhere near. In fact, we're actually below the 23% retracement. So we're back down that far. That's how far down the Russell is. After coming off of a cluster on Thursday and bouncing up, still very much in the reversal zone. After coming off of a bearish near-term peak, market sentiment's dropping. So we're not, it's a great day. We didn't follow through, but we're also not like, you'd have to get above 1800 for the Russell to be like, okay, now we're not bearish anymore. And we're at 1734. So let's see if we get the bullishness enough, at least on Monday and Tuesday, to warrant a change in the expectations. Short-term sentiment is bouncing on the weekly chart. We have, again, light pink shading in a yellow line. That's all indicative of a bull tag, which again either starts a really good rally from here. Generally, is when you're already on a bullish trend. This is a pretty weak bullish trend to produce a new bull tag. But it either starts, is a continuation of a really good bullish trend, or it starts corrections like this one, like all these others that I've shown you before. Every correction starts with a bull tag. Or, when you've already had a bullish move and you had a bull tag, if it doesn't start the correction, then it starts a new wave, a multi-month move to the upside. Really good wave. So really good opportunity. Again, you don't see it here because we didn't quite get the close below like you need to when you're light pink shading the yellow line. The line needs to be rising. You need to close below it. You need to get the light pink shading too with the intermediate line falling. So we don't quite have that, but you do have, we're above a falling market sentiment. Instead of crossing below a rising 30-week moving average, we're actually closing above a falling 30-week moving average. That's why we have the yellow line, and then the intermediate line just barely falling there, just below the 60th percentile. So that's why we have the yellow, light pink shading. So we'll see if this ends up turning into, it's not much of a continuation pattern to set us up for a new move to the upside. Again, this bear tag, which should start bullish moves, right? Just like bear tags start corrections, bull tags, bear tags should start the bullish moves unless they are, unless they don't, right? Unless they're selling opportunities and they start these moves to the downside. Well, the last one did produce a pretty good move to the downside, down to the 200-week moving average. This bear tag is produced, that was on November the 7th. We're going into April now. We're going into a 5-month-long sideways move where we just really aren't going in either direction, up or down. The intermediate line's been in the neutral zone for the most of this time, a little bit in positive territory. And market sentiment has still stayed flat in bearish territory. Avoided the reversal zone, but it's been flat. So That's the S&P. The NASDAQ, on the other hand, has been a lot more bullish. Dark green shading in a green line on the NASDAQ. Your short-term sentiment is above. The near-term line's rallied above. The intermediate line's rising. You're 9% above the 30-week moving average, the most it's been since this whole correction started. Again, you didn't get a bear tag over here like you did because we didn't close above that, and we didn't get a bear tag, bull tag either here. So we're not quite getting those tags, but you did get that one. So now it's a matter of whether we can actually break through here and hold this breakout above all these Fibonacci levels or not. So that's the bull case. The bear case is the Russell 2000. The NASDAQ has dark green shading and a green line. The Russell has dark pink shading and a red line. The intermediate line is falling fast. Short-term sentiment strongly bearish. Market sentiment is almost in the reversal zone itself. We're more than 4.5% below the 30-week moving average. It's falling. Again, we didn't get the bear tag, bull tag here because we didn't have yellow line. It's already red. But you had a bear tag there that produced a decline. You had a bear tag here that's try to get going sideways. Is now we're well below that level. So now the question is, which way does the rest of the market go? Does it go towards the select few? I mean, the FANG type stocks make up about half that NASDAQ 100, or do we go with the Russell, which is composed of a lot more correlated at least to sectors like the financial sector and the industrial sector, which have been a lot more bearish here, energy sector, which has been a lot more bearish during these last few weeks. And so, that's the big question. The NASDAQ's at these levels and trying to break through, and the Russell's nowhere near those levels, and it's actually down to where it's breaking through to the downside. So which way do we go? And of course, there's some indications that we can be bullish, as you saw on the NASDAQ. And even here on this weekly chart on the S&P, here's a reversal candle. It's not the greatest bullish candle, which is what you need when you're looking for a reversal to the upside. So the open next week will be at 39.47. We're currently trading at 39.70, so you're not going to get that big of a bullish candle. You have to close above this body, which is at 39.59. You have to close above this body to really reverse to the upside. You have to close back below this close to negate the transition candle there. So right now we're in transition on the S&P. The NASDAQ's not in transition. It's in full-on bullish mode, right? It had these transitions, and then now finally we got the reversal, right, to the upside. Big time reversal. And you can see last week's candle was a lot. That's the kind of transition candle you like to see. When you see a transition that looks like this, then if the real candle looks like that, then it's a good chance you'll get the reversal, right? You'll actually get the reversal to the upside. So, and you can see we're getting a golden cross. Very, very good. Story of two markets, right? The Russell 2000, on the other hand, not even close, right? We actually have lower lows, lower closes. We have falling PPO. We have a death cross again. And these are pretty deep, pretty good sized bearish candles that lead to trends. So, we're going in the wrong direction on the Russell 2000 here. So, again, a big time tail of two markets going on. Looking at the three green arrow charts, which has also been a difference, right? Because your Russell 2000 giving you three green arrows for 1, 2, 3, 4, 5, 6, 7 straight days. The Russell 2000 giving you three red arrows for days and days and days, for a few weeks here. So you have, that's a pretty big difference. And of course, your S&P and your diamonds are stuck in the middle with two green arrows on both of them. Kind of flirting back and forth between 2, 1, and then 2, and then 1, and then 2. But again, not light pink shading, not green shading, but stuck in the middle between these two down here at the bottom. Again, we've kind of saw this scenario where if I were to go back to the early part of late 2021. You had coming out for this November here. You were kind of fluctuating between white and a little bit of light pink, and then back to white and dark green. Green and three green arrows. Then you had this period here at the very end of the year going into January. For the IWM, on the other hand, coming out of that November expiration going into Thanksgiving, you were three red arrows that whole time. So the NASDAQ was kind of giving you a good, bullish move, and the Russell was not. And then by the time you got to the beginning of the year, you had three green arrows again with the green line, and this was a selling opportunity. So we've seen this kind of scenario before where you got, the Russell telling us bearish and your NASDAQ telling us, it's not necessarily the greatest bullish pattern, but at least it's not bearish, right? Like over here, you're a lot more bullish with the light green shading and the green line. So we've seen this kind of discrepancy. This is not the first time we've had this discrepancy before. Looking at the three green arrows in these lines, you can see we had the 8 and the 17 and the 200-day moving averages all crossing through today's range. We're closed above the 17-day. The MACD is above its moving average. You're still at that point of control, so you're not really breaking out. Breaking above 4,000 is a different story. Breaking above the 30 and the 50, but the 30s crossed below the 50, which is typically bearish. And so far we've rallied, which typically happens right around the time the 30 crosses below the 50. You typically get some kind of rally, usually after. But right now it looks like kind of at the same time, and you're still not crossing above the 30, right? So we'll see if that ends up being, especially if we end up holding resistance, which I expect that we will. The Qs they have broken through. The 8 and 17 are above the 30. The 30 still above the 50, never did cross below, and everything's above the 200. So looking really, really good on that. IWM, on the other hand, well below the 200. The 8 and 17s cross below, the 30s cross below the 50. You're well below the point of control, which is a lot lower. You're flirting with getting out of the value area. You are very bearish on the Russell. So again, as I mentioned, tale of two trades. You are below 25 on the positive. On the negative index, you're below 20 on the positive. So we got to get that positive above 25, really above 30, and get that negative below 25 and really below 20 if we're going to trend higher. So obviously that's not the case on SPY. It is the case on the Qs. We did drop below 30 on the positive. IWM, it's the other way around. The negative's above 30, the positive's below 20, and you got that rising ADX. So you see the difference, right? Very, very distinct difference there. SPX, the RSI is still kind of in bearish levels, just a little bit below 50, above 0, but not really, breaking above that positive 150 area. Your Russell 2000 is actually in bearish territory. Of course, your NASDAQ would be in bullish territory. Looking at the Ichimoku cloud, we're below the cloud. We've got a negative rate of change. You don't have a bearish trend anymore. You have a no trend right now. IWM is actually pretty darn mature in its bearish trend. Way significant bearish 26-day rate of change and well below the cloud. Your Qs, on the other hand, again, no trend. It's skewing a little positive, but because you do have a positive rate of change, and will have a positive rate of change unless we really drop pretty sharply here on the NASDAQ over this next week. Let's look at the Bollinger Bands and the Keltner channels. You can see that we are right smack dab in the middle. We're at the 150-day range low for the bandwidth, so there's no trend at all. We are right smack in the middle of that really small bandwidth, and the bandwidth is inside the Keltner channels, and whatever bearish momentum we've lost. Again, very different story than the Qs, which has been increasing its bandwidth as we push higher, and that we are outside the Keltner channels. We just got outside of them, though we're not trading outside the Keltner channels. We're still easily below it. So again, another kind of sign of maybe a little fake out there. IWM, you notice, has got a significant bandwidth to the upside or to the downside, as we've been trading down in the lower quartile and below the bandwidth with significant downward momentum. So very, very, obviously the financial issues we've been having has really impacted this index way more than the NASDAQ because there's a lot more financial exposure here. And of course you can see it's been pushing people from an equity standpoint away from the cyclical areas of financials and energy and industrials, materials, more into these safe haven areas, not staples and to a degree staples utilities, but technology and discretion or communication services especially has been where a lot of the demand has been going. We are set up next week for a bullish breakout. I don't know if it's going to happen next week, but we do have the The 4-week low points below the 70 level on the Arun indicator. We've already hit 0, so we've hit that. We never did get a big range to the downside. So, but we have to break through here, and we're going to have that high point's going to be there for most of next week, if not the whole week. And then after that, it's going to drop down to that high point. So we pretty much have to clear the post FOMC high point there if we're going to really change, get the bullish breakout, right, where this spikes to 100 and then the red line drops to 0. And the red line's almost below 50 without a spike. That's a long time. That's how sideways we've been. And with the range here, we're kind of setting up for a breakout move in one direction or the other. Of course, your Nasdaq's already had that breakout to a new 4-week high point. So we've already had that. It actually occurred before the red line dropped below 70, which makes you wonder a little bit. IWM, on the other hand, is nowhere near. Like, we're still at 100. We're still 6 days away from it dropping below 70. So it's got a long, and the bandwidth is pretty darn high. The Qs, you notice, is not, it's high, but it's not nearly as high as we've been so bullish. So I think, again, we kind of seems like we've been more bullish than we have been. The McClellan oscillator did finally get to a low negative levels, kind of flirting with positive numbers. Still stayed at -21. We're still at -400, so we're only 85 points away from hitting below -500. And what would be the shortest amount of time that's done that? I can't find another example where we've gone from 1,000 to -500 in 30 days, like we've essentially done right here. And that's a dramatic change, which makes me wonder about how bullish the Nasdaq is and how unlikely it is to hold up there, especially with the money flow not really confirming. The money flow is actually today hit a lowest point of this whole decline, even though we're not at the lowest point on the price level. The money flow is. So that just goes to show that the volume on this rally has been non-existent. So there's very bad breadth when you look at the breadth of how things are performing. The high yield, we'll talk about more in a second. The high yield's kind of showing that we're not really that bullish. There's our breadth. We're down to -500 on the new highs and lows. We rallied. We closed higher on the day on the S&P, on the Nasdaq, right? But we're at -500 on the new highs and new lows. The skew, which I mentioned to you before, usually spikes when we peak. And well, there's the spike. And we did yesterday drop below the moving average. We're a little bit above it now, but we are coming back down now, and it's been bearish when this line comes back down. And we've got a long ways to go back down. And we're when it drops back below its moving average, when the skew, as long as it stays above its moving average, you can still really rise, and you keep getting higher highs. But if we drop back down below that, let's ideally we'd like to bounce back up here on the skew, back up to high levels. That means next week we've been relatively bullish. But the fact that we're not, and we might be dropping here, is a sign that we might be getting the beginnings of this decline. Like, this wasn't the beginnings of the decline. We didn't get a spike on the skew, but this one we did. So this might not be the top of this little rally. This might be the top of this rally off of those December lows, and then now we're going to work our way down, right down to the downside. So volatility, you notice when you look at volatility here, you can see that we pulled back down on the VIX to 21. We pretty much always finish a week down on volatility, and we start the next week up. Again, a lot of uncertainty at the beginning of the week, not as much uncertainty on Friday at the market close, unless, again, we have really, a lot of uncertainty over the weekend. Obviously, that's not the case right now. So the VIX dropped down to 21.74. The VVIX dipped its toe below 100 for the first time in a while. If you look at where, that drop down here on the VIX to 21.74, you're sitting on its moving average here. So, let's see what ends up happening with this. On this crossover. Because all these MACD stochastics moving lower, so we're moving down. The question is, are we going to break below these moving averages, break below 20, and really get going? This would be the lowest level that we've broken down from. The last time we broke down below these lines was over here. See, we were just kind of flirting with them here, and here we didn't really break hard. So this would be the first time that we would break down and get all these lines breaking down too, since this one, and we were above the 200-week day there, and then over here as well. So this would be a lot lower peak than these two peaks were. So I mean, there's a much better chance we can drop all the way down to 15 if that's the case. Again, that would mean that we're really bullish, and there's not a lot of reason to have volatility over the next so many months. And again, that seems to be the less plausible scenario, less probable scenario. Possible, right, but much less probable into the potential of what's happening. As you see, as we finish the week here, we finished with a little bit below average range, 6.44, a little bit above average on the volume. So putting those numbers in the context there, 107 million on the volume is right in this area, so it's still pretty high relative to the 52-week range. And then down here we were at 6.44 points, which is on the average, which is right there. It's not quite 2%, but again, it's above 1.5%, and anything above 1.5% is not necessarily bullish unless we are falling. So it's a little bit below average, but that average is pretty high. It's well above the 1.5%. So you have some range that you can be below average and still not be at a bullish level. And again, with that money flow where it's at, we probably need some above average range days to the upside with some good volume to the upside to really get the money flow coming in, to really change, to get the breadth going. Otherwise, I mean, this is all, again, another fake out. As I've shown you this chart before with the NASDAQ compared to IWM, if you look at that, it's gone parabolic, and at some point in time, this is most likely going to correct. I mean, that's parabolic. That's a really, really high level for the ADX. Again, we saw that before get this parabolic in COVID. That was a COVID level, and we were coming off of major lows there. We don't have major lows, and last time we went relatively this parabolic was post-Thanksgiving in 2021, right before this whole correction started, where the Russell started to correct and the NASDAQ held up, the safety trade kind of held up, and at that point you can kind of see, what was that? Here, let me see if I can. It was right around mid-November all the way up to, let's see, where did we close? The highest level was right 182.50 on this level. So November 30th. So kind of the latter half of November, and you can kind of see here when you look at the comparison chart from that mid-November time frame, 2021, to the end of the month. You can kind of get an idea. Like, there's the Q. I mean, the Russell was falling 9% over the course through options expiration, through Thanksgiving into the end of the month, and the Qs are flat, right? So they were, the bonds, stocks, and they were a safe haven trade. Gold wasn't, but the Qs were a safe haven trade, and IWM and commodities and emerging markets all dropped hard, risk off, right? And so eventually we started the correction with that, and it looks like we might be doing a similar thing starting now. All right, now let's take a look at how things are moved in this to this past week. Let's start off with that 3-month time frame that we normally. Let's just go here. It's faster. 3-month time frame. You can see the Qs still best returning asset class for 3-month period, rolling 3-month period, up over 16%. That's a good 3-month return. I mean, if you were to go rate of change here. And we're at 3 months there, and let's go NDX. Here you're at 13% return over the past 63 days. If you look, it's not the highest, but if you follow my cursor along to where it was here just the day before, if you follow my cursor there, past 20 years. Again, there hasn't been very many other peaks. This is one of the strongest levels, and shoot, we just barely had a good, strong 3-month run just a while ago that culminated there in February the 7th. But if I were to do the 3-month chart then, going to February the 7th, a much different chart. So you can see a really bullish, commodities down, S&P, IWM down, and this was going back to the 27th here. If I were to go back to February the 7th, let's see here, it'd be February the 7th here, and then go, let's go 13 weeks. Whoops. So February the 7th, we're looking at to November. I had it, and I just lost it. So it's February the 7th to November the 9th was the 13-week period. Let's go to a daily chart. So there's the Qs up again about this much, 14, 15%. But everything was up. SPY, IWM was up, emerging markets was up, real estate. I mean, that's a much different story. The dollar's down, commodities were down, inflation was down, right? And that's the reason why we had such a really good return now for back to back. But again, this peak is much different than this peak. So it kind of goes to show again, kind of similar to what we had right there at the end of the year. Coming out of this November timeframe, again, the NASDAQ was up about 12.5% at the end of the year there. But you look at the Russell 2000 at the end of the year, and we were barely above, barely flat. We were negative, barely flat there. So very similar environment to what we saw at the coming out of this November timeframe. To what we saw then, we're seeing now, obviously for different reasons, of course, but same idea, and again, this time led to the beginning of that correction. And you wonder if we're getting the beginning of another correction, which this one would actually be the start of the bear market, because this would be like, again, I've shown you before, the Russell 2000, the S&P is still easily above its 200-week moving average, still easily above it. But your Russell 2000 is not. Your Russell 2000 is actually well below the 200-week. In fact, the 8 and the 17, the 30 weeks already crossed below, just because we had already been relatively bearish. So the 30 weeks crossed below the 200-week. The 8-week has 2. The 17-week, the 50 weeks also crossed. The 30-week is still below the 50-week. I mean, that's pretty bearish on a long-term time frame. So you're already getting that kind of the beginning of the correction. So you had that over here. You broke the 50-week in November, coming out of the Thanksgiving pullback there, and we just broke the 50-week. And by the beginning of the year, we were already below the 50-week moving average, starting the correction, right? Starting the correction there. Begin to go to the beginning of the year for the Qs, and you can see we were way up above. We didn't break the 50-week for another couple of weeks later, but you see how fast the Qs followed, right? How fast after that divergence played out. After this divergent peak played out, then they really dropped dramatically to catch down to where the Russell had. And again, you wonder if you might see the same thing again. We've shown this before too, from a credit spread standpoint. High yield is still showing bearishness. Like you can see, high yield relative to IEI is down. That's not necessarily the most bullish pattern. When you look at the same thing on an investment grade, so you think, okay, well, maybe it's just a financial issue with a high yield. Well, the investment grade, it's not, it wasn't up as much, so it's not down as much. But when you look at what it's doing right now, it is also below these moving averages. Now, it was up on Friday, but down below the 17-day, with falling PPO and a bearish trend developing across the board here. So we have turned bearish. The credit spreads have turned bearish on both high yield, which you would expect in this type of environment, as well as investment grade. We have seen the weakness, and that, again, is not necessarily the most bullish sign. And of course, what I showed you on Wednesday continues to be the case now when I look at the 12 grid for the different sectors. Again, when we're starting a bull market, they tend to all look the same. They're all dark green shading green line. They're all starting new bullish runs. Staples had a pretty good run here on Friday. Now has dark green shading and a green line. We're barely above 50. Communication services has dark green shading green line. Technology has been dark green shading green line this whole time. But everything else, you can see energy and materials and industrials and financials. I mean, they all have really low, around 20 or lower. Same thing with real estate. Same thing with utilities until Friday's rally. I mean, this is a bit. I mean, if you look at Friday's move, which you'd think, oh, we were just really bullish, right? We should have had a really good risk-off move on Friday to the upside. Well, when you look at it, you can see not quite so risk-off as your safety trades up 3% for utilities, 2.5% for real estate, which has been so bearish. Staples up almost 2%. Healthcare up almost 1.5%. And XLK, XLY, XLC all lagging behind. Again, that's not what you typically see in a bullish move, a bullish market, and big time performance. Now, that hasn't been the case all week. If you go all the way out to the beginning of the week, you can see that wasn't necessarily the case. You did have, energy and financials rebounding early in the week before faltering here on Thursday and Friday. Utilities and real estate have been dropping so much, and they rebounded in a big way on Friday, again, along with staples and along with healthcare. So it wasn't just these two areas, it was all the safety areas all across the board, but not including the Qs as a safety area, just specifically on Friday. So what has been a pretty good move, again, since the financial crisis started, going back to this March 9th time frame, since the crisis started and financials really started to lag behind, because I believe it on the 8th financials were still up, but let me check just to be sure. Yeah, so financials were down as well on the 8th, and let's see to this. Let's go. I think the 8th is let's go to the 7th. Financials were down on the 7th. How far back does financials? When did financials really start to suffer? Let's go back and check that out here really quick. I cannot hit a chart. It looks like they really started to break down on the 7th. So that was the day that they started to break down. So if I go back and look at the comparison since the 7th, you can see financials down 14%, XLK and XLC up almost 4% during the exact same time frame. But you can see utilities and real estate really suffering too, but utilities not really outperforming. It was originally a couple of down days here this week before rebounding, but it had been one of the better performers along with Staples. Staples still up there. And utilities did rebound, and healthcare is up there too. Again, safety trade, but again, these two areas which have been so bullish, non-existent on Friday as a safety trade. So you wonder again, are we moving towards safety, but without these other kind of cyclical areas, and they will eventually join the party where all these others are currently at right now. All right, so for our trade idea of the day, I want to take a look at Marvell Technologies in this XLK area, which have been so bullish, right? You'd expect they're probably not going to be able to maintain, I don't expect, they will maintain the bullishness. And Marvell has rebounded, not quite as much as everybody else. In fact, there's been, you notice, in a multi-expiration cycle range, really sideways range here. Market sentiments right in the neutral zone. The near-term line finished in the neutral zone, coming down from a bullish peak without really getting to bearish levels. Intermediate line rising. It's still below market sentiment, however. Looking at its long-term chart, you can see that, again, we were bearish, but now we have a transition candle, but it's not really the most bullish transition candle. So again, it's not something you expect to be a big reversal to the upside. Looking at some of the other moving averages here with the MACD and the stochastic indicators, we are still below the 50-day and 200-day and point of control. We are trying to get above the 17-day. MACD is trying to, we're trying to be positive, but nothing really too major here. When you look at some of these other oscillators to try to find like a trending indicators, you'll notice that they're both have positive and negative indicators below 25. Falling ADX are really, really low levels. No trend developed right now. We have, we had a weak bearish trend going. It's not there anymore. So you see that. You see the Bollinger Bands also at falling. The Bollinger Band had been relatively high, up in the upper half of that 150-day range, but it's falling now as we trade in the middle of the range. So you'd expect that the bands will come back inside the Keltner channels as we stay sideways. And so you say, okay, well, if we're going to kind of stay flat here, we had been, bearish, but then bullish enough to stop the bearish trend, but not bullish enough to start a bullish trend, then we can, as what we like to do is say, okay, well, let's do an iron condor spread at the low 20 deltas, selling the 37, buying the 35, selling the 45.5, which was a little bit lower on the deltas when we got into it, buying the 47.5, so going $2 wide. There's the trade, a normal position size. There we go. So normal position size. You don't have to worry about the earnings announcement. Pretty decent return. My break evens there, you notice, are outside the Bollinger Bands. Pretty much at the top and the bottom of that recent range, of that multi-month range there, with the point of control right smack dab in the middle, kind of acting as a center of gravity. At least you would expect it will act as a center of gravity here. And of course, if it breaks out, then it breaks out, and we'll try to keep our losses to $576 out of it. Don't want to take the full 1,000, but if we can take 576, then that makes it easier to recover that loss with another trade, rather than having to make a couple of trades to recover a loss if it gets all the way to 1,000 there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to us at marketscholars.com for free. Follow us and like our stuff on our content on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.